Well, we're starting to get demand destruction. The Federal Reserve is getting its way. Now, what a change we've had in the last 60 days. What a change we've had in the last 6 months. Because here we are in June, and last January, we had interest rates at 3.5% for 30-year fixed. Now we're pushing 6. That makes a big change. Now, as you know, I've been talking about this timing model that we've used for a long, long time. Now, my research goes back, and using an 18-year cycle, I've got a peak in 1969, a peak in 87, and a peak in 2006. It is textbook 18 and a half year cycle. And if that's the case, and it still remains, then we still have a lot of time. We've got another leg up, but we're having problems in the marketplace. So what does that mean to us? Does that mean that there's a more powerful cycle? Is there something that maybe is a 100-year cycle that's in operation? Or is the Federal Reserve so powerful that they're going to abrogate this 18-year cycle? It's possible. Now, these cycles have been very, very good. It absolutely nailed our mid-course corrections. Both of them, there were two, we got them both. Talked about the accumulation phase perfectly. It identified it wonderfully. But these models work until they don't work. There's no guarantee that this is going to continue. Here's the problem. This is the whole crux of the problem, is that the Federal Reserve sees inflation. We talked about inflation. Remember, we talked about inflation a couple of years ago. I saw it come into the producer price index. So we've had inflation in a way of virtually everything. You go to a gas pump, you know about inflation. And we've had a terrible inflation in housing. Now, we just received this. This is the Case Shiller 20 City Composite Price Index. Just got this from Zerohedge for the end of March. So we have about a 60-day lag because we're in June of 2022. And in the end of March, we had a 2.2% increase in the price of homes across the country. That's better than a 25% annual rate. That dragged the national increase is 20 cities up to 21.17% annual increase. It's just unsustainable. We can't continue doing this. Just remember that this is not a good thing and this isn't going to happen. But this is the problem. So the Federal Reserve has got a couple of choices. It's demand and supply. Supply and demand. That's the economic equation. You know, everybody hears about the supply chain problems. You know, the builders can't get glass, they can't get windows, they can't get frames. When you have limited supply, drives prices up. And as prices comes up, causes inflation. So the Federal Reserve has decided that they're going to go after the demand equation. And the way they do that is by raising interest rates. We talked about my timing model. We went through the bubble, and that bubble, when it popped, was phase 4. Overbuild, overexuberance, oversupply, and we have a recession. And then it takes a while to work off the recession. Then you start going into recovery. And when you have a cycle completion, it generally takes 4 or 5 years. And then we went into phase 1, which we started to get recovery. And that's where jobs start to get created. We start to have people moving into the locations. We start to get demand for our properties, and all the supply has been worked off. That oversupply is gone. So now you start getting to the point where you need some supply. This is where the builders start entering into phase 2, where the builders start building to meet the demand. I'm going to tell you, Phoenix, Florida, and Texas, the demand is off the charts. I am told here in Phoenix in June 2022, we need 220,000 additional units right now to meet the demand. And the builders aren't going to do that. They're scared to death. Actually, they're so afraid they're starting to slow down. They're not opening up developments. They're limiting the amount of sales that they have, and they're very, very concerned. But the demand is off the charts. So we're here in phase 2. We haven't gotten to phase 3 because phase 3 is the natural progression. That's where the builders make so much money. When they make money building, they want to build as much as they possibly can, and then they overbuild. We get oversupply, and you go into phase 4. Now, we're concerned we're going into phase 4 and we're missing phase 3 because we have demand destruction from our government, in which case, our models are going to go out the window. So that would be a very, very powerful force. Maybe maybe we're looking at like a 60-year cycle or a 100-year cycle that's overriding this 18-year cycle, because the 18-year cycle, maybe it's a weak cycle, but we're only in phase 2. And my cycle shows that we still have another leg up, but something is in operation. And I'm getting a lot of calls from people. They're concerned. And of course, you should be concerned. Now, this is the bubble. You can't miss this. When we got to the bubble, we had certain things that were happening. I'm in the rental business. My tenants were difficult to find. I was having trouble with tenants. I was taking tenants I normally wouldn't take because all the good tenants were out buying homes. As a matter of fact, I had a tenant that was having trouble making their rent, and they sent me a 30-day notice saying they're moving out because they bought a house. I'm thinking, how is it possible you could buy a house? You can barely make my rent. And yet they were buying a home because we had ninja loans. No income, no job, no verification. And I was having trouble with my rent. I remember we went into phase 4. We had oversupply. There was thousands and thousands of vacant properties virtually everywhere. The bill was really, really overbuilt, and nobody was using the properties. They were just shuffling them. They were buying them to be sold. Now, today, we're buying these properties to own. We don't have vacant properties where someone is moving into the property. Either an owner is moving into that property or a tenant is moving into that property. Now, why did you buy your property? Why? Now, if you're one of my investors, we bought it for cash flow. That's what we bought it for. We talk about a 5-year minimum hold because you need the income to live. This is there to supplement Social Security and your pension. And actually, the more and more properties you have, it's going to go way over what Social Security is going to give you. You're going to get a very nice cash flow. That's what we bought the properties for. Yes, it's really nice for them to go up in value. Odds are we're not going to sell them. And most of my clients are getting ready to retire and are starting to build their portfolio. And the demand for properties is still very, very strong. I don't want to be political. We just let 1 million or 1.5 million people into our borders that we didn't have, 6 months ago. They're going to need a place to live too. So instead of being short 4 or 5 million, we're going to be short probably 6 million homes. So that tells me that these people are going to have either two choices. They're either going to buy or they're going to rent. And rental business is going to be phenomenal. Rentals are going to be in demand. That's what we bought these property for, was for cash flow. You're welcome to call me. I would suggest you look at my video, 81 and Broke. That's a really, really good one. That's a true life story of one of my clients in 2003. Now, if you're one of our clients, and our clients, of course, have employees, they have staff, they have family, they have friends, they have children. We do a really, really good job if you're not a renter too, because we are really, really good at what we do. So if you're looking to buy or you need a place to live, your choices are very, very limited. You can either buy or you can rent. Those are the only two choices that you can have. Now, if you're going to say I'm going to rent because the prices are too high, let's just look at my very next chart, because this is coming from the Federal Reserve electronic data system. It shows for the last 70 years, every year rent has gone up. Now, it's pretty unsustainable what's going on here, Phoenix, Florida, and Texas, where you're seeing these huge, enormous rental increases. I don't think that's sustainable, but I do think you can see 5, 6, 7, 8, maybe 10% increases in rent. And if you look back here, you can see that the only time this rent even just kind of leveled out was during the great financial crisis, probably one of the worst times to be in business there ever was. And that was when we were working off all that excess properties. Rents seemed to come down just a little bit. I mean, rents came down just a bit, just a little bit. But here's what happened. People were losing jobs. They were getting as many hours as they needed to. They were having trouble qualifying. So because they were having trouble qualifying, they didn't want to leave where they were at in case they couldn't get another rental. So our vacancy factor went down to next to nothing. And tenants did not want to be labeled a problem tenant. So they were fixing everything themselves. Our maintenance went down to next to nothing. And then what followed was insurance went down, taxes went down. And so the net effect was virtually next to nothing. And that cash flow kept coming in month after month after month after month. So my business really went down, but our rental just kept cash flowing, sending us checks each and every month. And it became a lifeboat for us. It paid all our bills. It was just a wonderful, wonderful thing to have. And I'm anticipating that's going to be the case too. So you're welcome to call. I'm more than happy to consult with virtually everybody. I am with West USA. You're welcome to call us at our corporate office. You're welcome to reach me at michael@michaelville.com. We'll talk about what's good for you, where you are. We'll talk about your portfolio. We'll talk about some of the goals, talk about some of your concerns, talk about where you are and how we can help in any possible way. Please let us know. My very, very best to you.